So everybody hustle in and sit down. We have a great panel that I'm very excited to introduce to you. One might ask, why are we looking at kind of investors in this space? But ultimately, the capital has got to come from somewhere. And so I'm going to kick right off. And we have David from Cambrial Capital. We have Ava from the European Investment Fund with us here. And we have Steve also from Galaxy. And I will ask them to each introduce themselves in a little bit more detail and also their organizations, but not too much detail about yourself and the organization. Go for it, David.
So my name's David Fauchier. I'm the CIO of a fund called Cambrial. We are an investment advisor based in London. And we basically have a fund of funds strategy. So the idea is we will invest in other crypto funds on behalf of our investors. So we spend a lot of time, similar to some of the guys on the panel here, being sort of the money behind the money.
My name is Eva. I'm an investment manager at the European Investment Fund. The European Investment Fund is basically the European Union's arm to invest in micro, small and medium enterprises. Were established back in 1996, 97 to build a sustainable, self-sufficient venture capital ecosystem in Europe. But since then, we've started investing also into guarantees. So we guarantee loans for small businesses.
It's a problem when it makes sense.
Yeah, it's not easy to manipulate. And we also invest in private equity. Last year, for example, we committed 1.2 billion into venture capital investments across Europe. This year it will be 1.5 billion euros. We are basically, thank you, the largest venture capital fund-of-fund investor in Europe.
Great, thank you. Steve.
Hi, Stephen Kelso. I run Galaxy Digital over here in Europe. We are a $500 million balance sheet, $500 million market cap merchant bank. We have a single objective, which is to be the institutional client or investors' partner into the digital asset ecosystem. We do four things. We do principal investments, we do advisory, and the two businesses that we've been focused on most over here in Europe, the trading business and the asset management business. Thank you.
Great. So diving right in, and we'll go back to you, Dave, and we'll try and keep a kind of even spread here. I've striven my best over the last few decades to try and help build great companies here from Europe. But there are different perspectives on why it is that arguably the venture capital world is still a little bit behind the US, maybe 10-15% of the dollars or euros per capita in comparison, and now actually China has overtaken the US. What's your perspective on what's going on here in the European theatre?
From the sort of institutional money perspective?
Yeah.
I think maybe the first important thing is to sort of segregate out what institutional money is. It means a lot of different things. But even in terms of the skill sets, the risk appetites, and the sophistication of institutional investors, you're going to have a big difference between, for example, fund of funds, pensions, insurance companies, all the different sort of institutional pots of capital. And then you also have differences, I think, culturally between different European countries as to, again, risk appetite, sophistication, whether they prefer real estate type stuff or VC type stuff in terms of their alternatives portfolio. But I think the first thing to note is that for most institutions, like real estate and venture and hedge funds are already the alternatives. These are sort of the weird, risky, unknown buckets that they're allocating to with a small portion of their capital. And then within that, you're trying to pitch to people about crypto as a fund. And our own perspective on a very small sample set has been that US investors in general have been much more curious intellectually, much sort of harder working, much more happy to really dive in and figure out if there's something here. And then our experience in Europe, again, small sample size, has been that barring a few sort of rock stars and really smart investors, that it's been much more conservative, much less happy or willing to actually engage with the premise that this asset class may be worth looking at.
So some slightly kind of mediocre sentiment on Europe. Can we boost Europe a little bit more, taking a longer view and across venture in general, Eva?
Across venture space, initially VC in Europe, especially when we as EIF started, was a losing game. So for the first 10 years, our colleagues working in the private equity sector, investing in your typical PE funds, were basically laughing at us and telling us that they are sponsoring our activity. But within the past 5 years, the roles have changed. We generate higher returns as a VC team than the private equity team. So Europe has matured. It took time, but now European VC is actually a very valuable asset class. And we see more and more investors from outside Europe being interested in European VC. When it comes to crypto, I agree that in general, European investors are more, I would say, risk averse, more traditional in their mindset. As the European Union and as EIF, I must admit, we haven't invested in a fund that would be purely focused on crypto as of today. However, some of the funds in our portfolio do invest in blockchain as a technology, but also into crypto assets, digital assets. Why that is? Well, we are investing taxpayers' money, which means that, first of all, we have pretty complex mandates designed by European Union institutions that we need to invest, and they specify what kind of assets we can invest into. And since tokens are a new animal, we need time to prepare, and the European Union needs time to prepare a proper infrastructure for us to be able to invest. But this is already in place. So if you do have a blockchain fund, feel free to talk to me. Especially in the recent years, the European Commission has a very strong focus on the blockchain technology. There has been a so-called Horizon Prize of 5 million euros launched for blockchain projects aimed at improving social good. There is also an accelerator being launched with the initiative of the European Commission of 700 million euros to finance, again, blockchain initiatives for social good. So we see that blockchain has huge potential to change how the system operates now, and we think that there is a lot good to be done with blockchain.
That's great news. This feels like breaking news almost. No slight at the kind of EIF's marketing machine, but this is good to be able to get the message out, and it's a good antidote to some of the questions of the quizzical nature of David. Maybe Stephen, you can also add to that. Is the herd here?
The institutional herd is absolutely arriving, and it is here. So just the last point about sort of the relevance of Europe. There was a very big fintech survey published there a couple of months ago that actually highlighted, I forget what the threshold quantum was, but it cited that circa I think about 440 companies above a certain size had venture deals invested in them in Europe, compared to about 340 across both Asia and the rest of the world, ex-Europe and the US combined recently. So, that's one very powerful anecdote for me, that Europe is very much relevant and increasingly front and center for the international, the global, and like my company, the American investor set. Secondly, anecdotally, this morning we heard from the head of ventures at Mubadala, the big Abu Dhabi oil investment firm, that he's relocated here because they see a lot more opportunity in London in the next 10 years than Silicon Valley, and that's a big statement. But from my perspective within Galaxy, is the institutional herd coming? It absolutely is. There were 3 significant developments last year, sort of between Q3, Q4. the most significant of which was the US endowments announced that they weren't just looking at the space, they had already invested in digital assets. And these US endowments, they were led by David Swenson of the Yale Endowment Fund, closely followed by 4, 5, 6 of the other big names, including Stanford, MIT, and so on. And the significance of that is that the US endowments represent the pinnacle of the biggest pool of actively managed assets globally, which is what we refer to post the GFC as the multi-asset investment arena. And, very simply put, these are, the first, the most accomplished investors in the space who have applied science to diversification being the first rule of risk management. And they applied the CAPM model, and they've done it very effectively. So I believe that really started the race for the rest of the multi-asset investment community really to look over their shoulder and say, okay, maybe we need to look into this. So that is, that happened Q3 last year. And then in no short order, crypto actually had a 45% fall thereafter. And a lot of people were, long faces, oh, where's the relevance of that? But now, what has just actually come out, I'm sure most people will have seen, the Fidelity Institutional Manager Survey, where 411 institutional managers, clients of Fidelity, were interviewed, and 22% were already invested in the digital asset space. And, that for me is like, that's the most significant thing since I've been in crypto, because that says to me, okay, it's not just a promise, now it's actually happening. And
what's going to be the rifle shot that starts the actual stampede, rather than kind of milling around?
So I believe the rifle shot is going to be this. I think that a number of managers, institutional asset managers, have now put their hand up and said, okay, we're in. So I believe what's going to happen is we read the financial press, and it's negative about, particularly about the asset management space, and there's been a very high profile case here of falling from grace, whatever, and all the naysayers come out and pile in and go, oh yeah, this fund manager, he didn't do this, that, and the other, where were the governance, etc., etc. But I think what's going to happen is in the next few months, sooner rather than later, we're going to see some of these institutional asset managers who have already invested in crypto start posting very different, significantly higher performance numbers because of the benefits of adding an allocation of crypto to your multi-asset portfolio. And we've done some research pieces ourselves internally. There are other companies out there that will actually show the implication of having some digital asset allocation to your multi-asset portfolio, and it's tough to argue.
Sounds good. Glad that we're live streaming that. We're getting the message out. So, David, back to you. Given this is a new asset class, and you've got a kind of a focused but very broad view of the different ways investors are tackling it. What's your message to Europe as to what the core competence is that's required?
So, the first step, I think, for people, and we do see a big disconnect between American endowments being really leading at the forefront of this and some other players. The first step is to say I want to get exposure, but then the question is sort of how. And there's about 5 different ways you can get exposure to crypto. You can go buy some Bitcoin. You can go and build your own portfolio of assets, which I think around Bitcoin there's a very sort of reasonable thesis around sound money and this having a more than 0% chance of actually being worth something over time. Especially if we were to see a sort of not very clean unwinding of this whole modern monetary policy theory of the last 10 years. So there's sort of the Bitcoin thesis, and you can go and buy that. And the conversations we're having are sort of, should we allocate to a fund or should we just go and buy Bitcoin? And there's sort of a lot to be said for people buying Bitcoin, but then you're missing everything else. So then you can go build your own portfolios, but if you're not really a VC, you don't understand how to do that. So that's probably a bad idea. You can go buy an index, which typically is what you would go and do, and this is sort of a default response for people. The problem is that a lot of the indexes or the indices are, market cap weighted, and the problem is that market cap weighted indices are based on an efficient market hypothesis, which says that professional capital allocators are in a space correctly pricing assets and therefore, the top 10 is going to represent assets of value. The issue in crypto is that a lot of the prices are set by retail investors, and they're bouncing up and down through sort of massive pump and dumps and waves of hype. And so I think an index is a very dangerous place to go and be. And so then you can go and say, well, we're going to pick a fund. And then the question there is, yes, I want to do a fund, but what kind of fund? Do I want a VC fund? Do I want a liquid VC hybrid type fund, which is like an open-ended hedge fund like Multicoin or what Polychain did, that's going to invest in these early stage assets, but then you have your own risk-reward trade-offs? Can you go and do something in the market neutral space where you're just profiting off the volatility, or something else? And so I think there's a huge amount of thinking and due diligence that needs to be done, and that fundamentally the market structure of crypto is very different. And so our perspective as an investor is that we need to be completely agnostic as to fund structures, because these are changing all the time, because the environment is changing all the time, and we need the underlying managers to be agnostic as to the underlying instruments that they're investing in. So if you look at 2014 to today, you used to only invest in tokens, and these tokens were released very early on in the sort of life cycle of a protocol. You think of Augur, which had no real product, but had a token that they released really just for the fundraising. And then you flip that to today, and now you have SAFT and other forms of convertibles. You can also buy equity in a company that gives you a call option on the tokens when and if the network launches. You have all sorts of variations. And so from a 10-year time period that we look at it from, the question is really, can we be agnostic as to the fund structure, because these will shift over time, and can we be agnostic as to what the manager is actually investing in, so that they can follow the opportunity to where it is year on year? And that's why one of the things that we look for is in our diligence, it'll be look at the LP base of a particular fund, and is that LP base going to give them the flexibility to invest where it makes sense? Because in 2017, it made sense to do non-liquid market investments, and in 2018, you could pick up leading projects that already had a liquid token at cheaper prices than the private deals. And so you could actually profit from, if you were set up to do it in your LPA, profit from these massive swings of kind of bull and bear markets. And so
there's a lot of things you covered there, but I think at the end it sounded like there was perhaps a question that we could pass over to Eva, because we like the news that this is an imperative from the European Commission, that there are funds allocated to research and venture and providing sophisticated customers, and that's great. And you're ready for blockchain funds, but are you ready to give that kind of flexibility to your underlying managers to be successful? Add something more if you want, David, to that question.
No, that was my question in a lot more words.
I think I cannot say that we can give the full flexibility of whatever structure and whatever instruments, unfortunately. What we've been very comfortable with up till recently was security tokens, because they basically mimic what we know very well, which is equity. Now we are getting comfortable, I would say we are comfortable with utility tokens. What we are not comfortable and will not be comfortable at all, given our mission at EIF, which is to support SMEs in Europe, and this means long-term support. We want to invest in managers that add value to underlying portfolio companies or to entrepreneurs who help them build businesses, who provide the right networks, etc. So what we cannot do is allow our managers to invest in cryptocurrencies for purely speculative purposes, which would be probably investing in Bitcoin, etc. So yeah, I would say for now, given my understanding of what kind of digital assets are out there, I would say cryptocurrencies, if for speculative purposes, no. If there is an underlying asset that can be developed over time, then yes. Security tokens, yes. Utility tokens, yes as well.
So I mean, it ties directly back, obviously, to the mandate from the European Commission and encouraging entrepreneurship and small companies. So it makes total sense, and I definitely applaud that. I mean, so we're still, to remind everybody, we're still in a situation where Europe in many ways was overlooked by the US venture capital industry just when it hit its stride in the dot-com boom, and we're still at somewhere between 10 to 20% of the venture capital per capita that is in the US. And just to kind of do my little bit of a flag waving for Europe, we have more people, we have more developers, we have more STEM PhD graduates per year than the US, and we're hearing there's an awful lot of fantastic project activity, which possibly in this space, which it has elements of counterculture to it, is not surprising, because folks have seen a lot of extreme types of culture and political environments in the last 100 years. So I think, on top of the fact that we see up and to the right generation of outlier returns from Europe in venture capital in general, those factors suggest that the next 10 years should produce a lot of Web3 results in Europe that are going to make for great venture capital investment. So that's good. Steve, as you fired the rifle shot, these institutional investors are piling in. Where do you see them kind of maneuvering themselves to first? What are the kind of the early opportunities? And aside from quote unquote the herd mentality and the social proof of people getting in, what else are people looking for to give them comfort?
So asset management, in my experience, is about two things. It's about managing assets to make money, and it's about looking after your clients so you can raise money. And the two ways that you look after your clients is you demonstrate empathy and relevance to what they are trying to achieve. And the empathy part, you have to understand the personal influences, what is motivating those individuals on an individual level, on a corporate level. And I think, simply put, what is it's the need for performance, right? And the need for performance is increasingly clear. Mm-hmm. And I observe that, the three big challenges in financial services, from a 80,000-foot level, if you look at the sell side investment banks, their biggest problem is that, the buy side, the big hedge funds, are increasingly doing what they do, or used to do, because the investment banks no longer have the balance sheet nor the risk appetite. They're not allowed to. So you look at the asset management and the buy side, the hedge funds, what's their biggest problem? It's increasingly the active manager's role has been taken over by passive investing. You can now replicate in a spreadsheet or a few if-then statements actually a lot of the secret sauce of what active fund managers were doing. And then if you look at the third big category of financial service players in this part of the world, the exchanges, the brokers, then unanimously MiFID will ring out as the biggest challenge that they're facing, and the lack of clarity about the regulations. So back to the products that the Galaxy have, we start with the trying to be relevant to a predefined number of institutional clients. Mm-hmm. We understand the hurdles that they have to go through. They can't just go and invest, ad hoc in any particular structure. That does not tick the box for what their mandates allow them to do on behalf of their third-party investors. They have fiduciary responsibilities. They're not allowed to just go and invest in this, that, the other on a whim. So, the dilemma, the balance, is to understand what they can and can't do whilst giving them what they need, which is the performance. Mm-hmm. So that's why, currently the product we're seeing most interest in is actually our index. It's a passive tracker fund for our Bloomberg Galaxy Crypto Index. But really, it speaks to David's point. It's not a pure capitalization weighted index. It gives a 30% cap to the biggest names in the space, but it also leaves enough room to boom for the second companies. So you could think of it almost as a little bit of a hybrid that is tracking this index. It does participate in the momentum of the big crypto currencies, but it also gives enough exposure to those ones that are coming up.
And that's open just to institutions, or?
It's an institutional asset product, fine. Absolutely.
For the moment. So I think we're into kind of rapid fire wrap up territory. So two questions at the same time. So it is arguable, although not predictable, clearly, that we're heading towards the top of some kind of, longer macroeconomic cycle. So question one is, what do we think the impact of that is going to be on venture and on crypto? Some dynamics there, good, bad, no difference. And the second question is, what year would you say that we'd see a fund, venture or not, that is denominated in an internet sovereign coin, token, currency, be that Bitcoin or something else? So a little bit of crystal ball gazing. You go first.
You have Bitcoin-denominated funds. We can only do USD, and so there are managers that we'll speak to, and unfortunately we sort of can't progress the discussion because they'll only accept Bitcoin. And in our conversations with LPs, there's also a lot of interest from Bitcoin hodlers to just put that into a fund. They don't want to sort of cash out of that exposure.
So for institutions coming in.
So for institutions coming in, I don't know. What was the other question?
Macroeconomic cycle.
Yeah. The way we see it, it's two very separate questions and pitches. One of them is around Bitcoin and one of them is around sort of everything else. Around Bitcoin, you've got something that might be digital gold, that might come to have a social consensus around it, which we see as actually forming at the moment, which is that this is sort of a safe haven asset. It's your, custodial, bearer asset that can't be seized, that can't be confiscated, that maybe will track sort of the price of gold. And if we have a crisis that is driven by a crisis of confidence in modern monetary policy, or in fiat money, then that potentially is a very good thing for Bitcoin, and you could see trickle from there into the rest of crypto world, which we've traditionally seen. But other than that, I think the rest of crypto is very much a risk-on asset. I assume if we had a big financial crisis like we did in 2008, investors will be driven by a need for liquidity, and so they will not want to commit capital for 10 years. I think that's typically what you see. And the only way to invest in sort of non-Bitcoin interesting stuff is typically through a non-liquid vehicle of some kind. And so
CogX.
Yeah, it might end up balancing itself out, but it really depends what the cause of the crisis is.
Got it.
Because if you have a normal recession and that doesn't spike Bitcoin, then it's sort of all of the negatives have aligned.
Got it. Thank you. Eva.
I think that the blockchain technology offers a great advantage in a time of crisis. Because it makes fundraising much easier than traditionally. So at a time when probably it will be hard to fundraise for VC funds, they will be able to fundraise using basically token issuances. And so we already see that. We are talking to one fund in Israel that is doing this. So as for the second question, I think it's not that far away.
Got it. Okay.
So
when would the EIF invest in a Bitcoin-denominated fund?
Hard to tell.
Okay.
But I hope not in the far future.
Okay. Very good. Thank you.
Okay, so I slightly disagree. I in large part disagree with the tone that the implication of it takes a crisis. It absolutely does not take a crisis. And I think, we are clearly in a very advanced stage of this most extraordinary investment cycle, the most extraordinary in 5 generations. And it's very clear to me, having spent 25 years trading volatility, that volatility is set to rise from these low levels globally. And of course, we're starting to see that around. And it's the fact that as volatility goes higher, that asset managers can no longer apply the same degree of leverage to their existing multi-asset portfolios. So that is why, in my opinion, the US endowments, that is why multi-asset investors, that is why 22% of Fidelity's 411 institutional asset managers interviewed are already in, because they understand that here is an asset class that has the upside octane without the leverage, and lo and behold, also without the correlation to the commercial real estate, the fixed income portfolio, and the equity portfolio, which is an added bonus, as we know. So for me, it's already happening. It is any mild deterioration whatsoever in the macro is absolutely accelerating this, no doubt about it.
Sounds good.
And that's the institutional part. From the bottom up ground roots, I think we've all seen, the population is demanding this. And to your second question about when are we going to see a Bitcoin-denominated fund, they're coming, clearly.
Imminently.
Yeah.
Great. Fantastic. So I take a very positive message away from all of that. We should all be keeping all of our savings in Bitcoin and then speculating in tokens patiently and diligently. I think I'm looking for A o'clock or B anyone to cut us off, which normally I get some of this, but are we timed out? I'm not getting any. I think we're at the end. So, or more or less, given that nobody is throwing us off the stage, does anybody have any questions for the panel? Mic coming around. Yes, there's one here in the center.
Hi, Fred Becker, Luminous Ventures. Questions about the ICO market, given the disaster that happened last year into this year, the number of, I heard various statistics out of the Boston University study, 50%, 75% either worthless or can't be traded or whatever. Do you see that correcting itself, more regulation? How do you see that playing itself out?
Anybody?
ICO is one form of primary issuance. So if you accept that crypto networks are useful ways of coordinating work and that a token is like a necessary part of the security model, then for a crypto network to work, you're going to have liquid tokens. And so the question is, how do you go from no tokens to this primary issuance of some tokens that people can have and trade? And so ICOs are one way of doing it, which has historically been done as a fundraising mechanism. You can do airdrops. There's lots of different ways you can do it, and I think there's very few serious quality projects doing ICOs, except for exchanges that have been doing IEOs, which is sort of the same. It's one of many different ways that you might actually get tokens out into the network, and there are also other ways of fundraising. So I think we won't see another sort of wave of ICOs like we did, but that doesn't mean that projects can't raise money and that we can't get tokens out the door.
Anybody else?
Agreed.
Agreed. Good. Thank you. Another question. There's one down here. Well, so last question. Unless anybody's going to... We'll do super fast, and then we'll do one.
Thank you. Chris Haley from Nesta, the Innovation Foundation. I don't know if we have any in the room, but if we had regulators and policymakers here, what would you say to them? Do you think that the UK in particular is doing enough on the regulatory side to encourage the issuing of digital assets?
Great. And let's get this question in, and then we can tackle them all at the same time. Thank you.
I was just wondering, what would you recommend to asset manager with excess of cash in terms of crypto assets?
The question is, if you've got too much crypto, what would you recommend they do with it? So 2 questions. Regulatory.
Okay, I'll take the regulatory one first. So what would I say to regulators? I would say welcome. I think from my perspective, in Europe, which is our jurisdiction, we saw a lot of the small island, traditional tax beneficial jurisdictions take a very early lead into crypto because it was relatively easy and nimble for these small groups with small numbers of stakeholders to make a pretty clear risk-reward decision about are they or are they not going to advocate and support this new asset class. And that's why we saw all the usual the Jersey, Channel Islands, Isle of Man, Gibraltar, Cyprus, Malta, and a lot of them did a lot of really good things. But from my perspective, and this is not a Galaxy official position, but from my perspective, I think the UK and Switzerland have already won as the 2 crypto capitals in this part of the world, not just because these are the number 1 and number 4 financial centers where the money is, not because of 10 years of Bitcoin flows, but because of 300 years of capital flows from many emerging markets into these developed markets through those two portals of London and Zurich, and that's what the City of London's half built on. So too Switzerland, and I just think the regulators in Switzerland in particular I salute them. They really got their act together really quickly, very, very proactively. They really were the first big financial centre to get out there and take a stand. And I observed that here in the UK, we're taking a very close lead from the Swiss now, which I salute.
And the second question, I think you'd probably just like send me your private keys. Is that kind of
Yes. With regard to the question on regulation, I can only say from the EU perspective, it is taking a long time, but there is a partnership of European countries working on a common blockchain services infrastructure. I'm guessing that it will take a lot of time for all of the 27 EU countries, 28 EU countries, sorry, not intended, to come up with a common infrastructure. But we see already a lot of government-led initiatives in many countries, like government of Sweden, of UK, of Estonia, obviously, always leading the innovative initiatives. These governments are already doing a lot.
Let's hope that competition leads to a speed that is faster than the SEC.
Exactly. As for the second question, I suggest you talk to Stephen.
I just want to point out one thing which I think is remarkable and very English of them, which is the FCA's approach to regulation is incredibly smart in that it's explicitly principles based. So they about 10 years ago basically shifted away from saying, these are the rules that you must follow, and if you follow the rules, you're fine, to just saying these are the principles that we want you, for example, as an asset manager, to achieve. And it basically says do no harm. And I think that's a wonderfully intellectually flexible way to encompass all sorts of ranges of things that may be done by different asset managers, and in the case of crypto, by the entire crypto ecosystem. So really, I would urge regulators to explore the idea of really making it principles-based, because the underlying economic models of these assets are changing all the time. Everything is shifting very quickly in crypto, and when you have these massive cycles of, anyone with a government mandate is going to take 2 or 3 years in order to be able to change that. By the time you've gone through that whole loop, the whole crypto world has shifted, and what you've said may be right for a time, but that time doesn't exist anymore. And so being principles-based is I think, probably the right way to think about regulation in this space.
I think it's a wonderful point and a great way of wrapping up, that if we can be principles-based in how LPAs are defined for the managers, and maybe the EAF can lead the way, that would be great, because this is an important area on a kind of geopolitical basis, which the European Commission does recognize. Not that we want to beat other people, but we want to be successful as Europe. Thank you very much.
Thanks.